Good afternoon and welcome back to another Money Not Math episode. This is episode number 159, titled Five Strategies for Riding Out the Market Roller Coaster. I know things are volatile, as usual. The news is scary. We're trying to sell more ads. But keep in mind, the long game is what matters the most. So in today's article, or in today's episode, we're going to be reviewing an article from Morningstar.com titled the Five Strategies for Riding the Market Roller Coaster, written by Cheryl Rolling. It is Monday, March 31st. First quarter of the year is almost done, which is crazy to think, but the chaos has just begun when it comes to the Trump administration. So I think this is a timely article that I hope brings you value. And the article talks about these tactics can help you to navigate the stock market's ups and downs through volatile periods. Once I review the article, I'm also going to show you an outline or a probability of positive returns graph that I hope helps you have more confidence when it comes to your long-term strategies. And if it doesn't, or if you have questions, please reach out. I'd be happy to answer your questions and potentially help you with your long-term retirement planning and overall financial goals. So with that, let's jump into the article written by Cheryl. She starts out by saying, as you are likely aware, the stock market has been wild lately. Always. Alternating between nosediving and bouncing back. It's enough to make even the most seasoned investor a little nervous. But before you reach for the antacids and start panic selling, take a deep breath and remember, volatility is a normal part of investing. The key is to have a plan and stick to it. Here are five strategies to help you navigate the market's ups and downs. First, embrace the long game. Investing is a marathon, not a sprint. Do not get caught up in the day-to-day drama. Remember why you invested in the first place. Long-term goals like retirement, a down payment on the house, or your child's education. History shows that markets tend to go up over time despite the occasional bump or shoulder in the road. And I think this is extremely important to remember because the news, your brother or your cousin Jimmy, and the fear mongers out there want you to react. Your reaction, whether it's turning on the news more often or buying or selling, is what helps other people. It doesn't necessarily help you. All right, so stick around and like I said, I'll walk you through the graphs of historical evidence to support this. But it's extremely important to remember, embrace the long game. We do not make long-term decisions based on short-term events unless they're your personal life events, not things we can't control. Number two, diversification is the way to go. Spread your investments across different asset classes, domestic and global stocks, potentially bonds, real estate, and so on. This way, if one area takes a hit, your entire portfolio will not go down with it, hopefully. Maintaining your diversification strategy helps smooth out the ride and reduces your overall risk. Keep in mind, this is based on historical data. History does not determine the future. All right? We cannot predict the future. We will not predict the future. It is not, in my opinion, in my professional advice, a good idea to try to predict the future. So diversification is the best thing we can do to try to mitigate risk and short-term volatility in one or two markets, or asset classes for that matter. Number three, rebalance periodically. Think of rebalancing as your portfolio's regular tune-up. Over time, some investments will grow faster than others, throwing your original asset allocation out of whack. Rebalancing involves selling some of the winners and buying more of the losers to get back to your target allocation. This disciplined approach forces you to buy low and sell high, the opposite of what emotional investors do, which can boost your returns and lower your risk over time. This is extremely important for multiple reasons covered here. I'll give some examples. First, I've had many clients who are investing in their 401k for many years, and let's say they're investing at a 60% stock, 40% bond intention. Well, over time, historically speaking, stocks grow almost twice as fast as bonds. I think the historical average is around 10% growth for stocks and around 5% for bonds. Well, if you aren't rebalancing, it can get way out of whack. Literally had clients, so I review their 401k holdings, and even though they're investing at 60% stocks and 40% equity, if they aren't rebalancing, their holdings could be something like 90% stocks, 10% bonds. Way different than what they think their risk is when it comes to how they're exposed to the market. So that's the number one importance of make sure you're rebalancing. And if you aren't, I'd encourage you to either set it up automatically or find an advisor you trust to do it for you. We do it for our clients. They don't have to think about it. They just know we're doing it in the background. Um, with that, rebalancing involves selling some of the winners to buy some of the losers. This is investing 101, right? When things are up, that's the right time to sell if you know. We don't predict, but if you know when things are up, it's a good time to sell. When things are down, it's a good time to buy. Emotions and the media often try to scare us into doing the opposite. They try to say, oh my gosh, the market is doing terrible. You got to get out. You got to get out. Well, guess what? In 2020, when the world was supposedly going to end due to COVID, Ukraine war, inflation, all these things, the market ended up going up like 30% over the next 3 years. So if you would have listened to the media, you'd have missed out on all those gains. Now, on the flip side, our emotions, if we just use an easy example, if let's say you bought your house for $200,000 and the market was going great and your house was worth $400,000, are you going to think about selling it or are you really excited at the fact that it went up? Well, if you're going to sell it, that'd be the right time. On the flip side, if you bought your house for $200,000 and the market took a nosedive and your house is now only worth $100,000, are you going to sell it? Are you going to eat the losses just because it's down? Are you going to say, oh no, my house is worth less. I better sell and move on? Probably not, right? That's a bad time to sell your home because not only are you losing money on the purchase, you now have less money to go buy something else. That's the same thing with the stock market. If you are reacting emotionally and you're selling when things are down and buying when things are up, it's going to actually hurt you rather than sticking to your long-term plan. So, extremely important to remember all of that, and also know that by having your dividends reinvested from your fixed income or yield, or sorry, dividend from your equities or yield or fixed income yield, by having that reinvested, you're automatically buying low and selling high per se, because when the market is down, you get to buy more shares, and when market's up, you buy less shares, so that over time, you dollar cost average yourself into a higher return. All right, so that's extremely important. Number three, rebalance periodically. Number four, and this might be the most important from an emotional standpoint, but it's really important also from a logical standpoint. Turn down the noise. Financial news can be a constant source of anxiety. Doomsday predictions and market hype are designed to grab your attention, not to encourage sound financial practices. I would bet most of the people on the news that are talking about finances and stuff don't have a legal license to actually give you advice. They're there to sell you ads or sell the company ads so that they can stay on TV or the radio or whatever. Limit your exposure to the noise and focus on your own financial plan. Resist the urge to check your portfolio every day. It won't change the outcome, but it might lower your blood pressure. Number five, harvest those tax losses. So this is again depends on your situation. I think this one's the first four applies to everyone. This one applies to some people, but it's not always a good idea because sometimes harvesting tax losses can hurt your long-term gains by selling low rather than buying low. But I'm going to say it anyways because it's in the article. Number five, harvest those tax losses. Believe it or not, market downturns can offer a silver lining, the opportunity to harvest tax losses. This involves selling investments that have lost value to offset capital gains elsewhere in your portfolio, reducing your tax bill. Just be sure to follow the wash sale rules. Don't buy the same investment within 30 days to avoid IRS disallowing the tax benefit. And also, again, keep in mind the long-term ramifications of selling compared to the short-term potential gains of the harvesting the tax losses. So hopefully those five things were helpful. The bottom line is market volatility is a fact of life, but it does not have to derail your long-term financial strategy. By following these recommendations and staying disciplined, you can ride out the storm and stay on track to achieve your goals. Now, with that being said, let's check out the graph that I promised to show you that further supports, I believe, a lot of the points that were just made. All right, so hopefully this is showing up for you. Let me move my face out of the way here. So what this is a probability of positive returns of the S&P 500 since 1937. And this was created by First Trust Portfolios LP. I found it online, www.ftportfolios.com. So I did not create this. It's out there. They did their research. They have the disclaimers included. So hopefully the information is really accurate. I believe it is. And what the important thing is here is to understand that on any one day, historically speaking, the market's up about 53% of the time. Not that much. It's basically like flipping a coin. which is why reacting emotionally is a bad idea. And trying to predict the future is a bad idea on a day-to-day standpoint and picking and trying to time the market and things like that. Over any 1 year period, the market's up 78% of the time. That's a pretty big difference. We go from about half to 3 out of 4. Over any 3 year period, the market's been up historically 87% of the time. Almost 9 out of 10 times, the market will be up on over a 3 year period. Over a 5 year period, now we're looking at 93% of the time historically, the market is up over any 5 year period. That's relatively low risk when you have long-term goals. Over a 10 year period, the market's been up 97% of the time over any rolling 10 year period from 1937 to now. That's extremely high percentage. Right now, keep in mind, history does not determine the future, but if we believe history will repeat itself in some relatively similar form in the future, it's important to understand that when we're investing for long-term goals like our retirement and our retirement income and our legacy, we're looking at things longer than 10 years, periods of more than 10 years, not periods of 1 day or 1 month or 3 months. So keep in mind the long-term approach to your financial plan is extremely important, and understanding what your personal goals are is more important than listening to the noise and the fear mongering that's out there. So with that being said, thank you all again for your time. I genuinely appreciate it. As always, if you found this conversation to be valuable, or this Money Not Math episode to be valuable, please help me provide more value to more people like you by sharing it with a friend, sharing it on your social media, commenting with questions or thoughts, and or if you'd rather have a more private conversation, you don't want your comments to be seen online, you can reach out to me directly at drew@fivestonefinancial.com. I'd be happy to answer your questions or schedule a meeting to have a brief conversation to determine if A, I'm just here to answer your questions for free, or B, maybe it makes sense for us to work together on your long-term goals. With that, remember, disclaimer, this content is not legal, tax, or investment advice. You should always consult a qualified professional regarding your personal situation. And even though I am licensed to give financial advice, unless we actually sign some paperwork to work together, I'm not giving financial advice today. I'm giving ideas to think about. All right. So thank you so much for your time. I hope you have a wonderful day. Bye.